Please remember that nothing we say here should be taken as personal advice. The conversation is for entertainment purposes only. If you have questions about your financial situation, please talk to a licensed financial advisor. All right, welcome to another episode of Future Money, the last and final episode of Future Money, where we talk about the investments of the future.
That will make you money.
All right, well, the year is coming to a close.
Yes.
Mercifully for the markets.
I thought we were going to get a Santa Claus rally.
I think Santa's on vacation this year. I think we can't, because we can't just say Christmas anymore. It's got to be holidays. No.
Fuck that.
It appeared that the Santa Claus rally was coming, but then the Grinch, a.k.a. Jerome Powell,
Yep.
had to step in, and unfortunately, Santa's been delayed a little
I'm
bit.
over all these central bankers, man.
Dude, the guy is probably like loving his new celeb status.
It's kind of crazy, right?
Yeah, and
I actually I woke up early this morning around 4 a.m. PST, and I turned on Bloomberg and I watched the Christine Lagarde, which is the ECB chief, also doing a press conference.
Oh, yeah?
She was even more hawkish than Jerome Powell was.
Yeah, it's
I don't know,
crazy.
you got a war, you got a basically recession in Europe.
Yeah.
And you still want to raise rates and be as aggressive as you
can.
can.
Europe has a weird thing that I was reading about also, right? Because they have the inflationary stuff also, but they have high unemployment, like compared to what we do. So they actually have a bigger problem.
Way bigger problem. And also they have an energy crisis. We don't have an energy crisis here.
Yeah.
So, and it's and I get it. Like, we'll talk a little bit about inflation today. Yeah. But I think Europe is in a much, much tougher environment than we are. And yet they're still tightening very aggressively.
Yeah.
She was actually even more hawkish than Jerome Powell, which I was like, wow, that's pretty interesting. So
So
anyhow,
it's been going to be a nice close to the year. Maybe we'll get a Santa Claus rally as we get closer to Christmas.
Yeah.
But
we're going to be cheerful.
We're going to be cheerful. It's the holidays. It's a time for hope, and it is the season to be jolly, as they say.
Yeah, exactly.
But we want to do like a year-end review, recap what we talked about, what happened this year. Again, obviously this was not an easy year.
So let's get this out of the way, man. What the heck is going on with this dude?
Elon?
Yeah.
I wish listen, Elon's always been crazy. There's always a fine line between crazy and genius.
Jumped the shark, though. This is
I think with more power comes more crazy.
Right.
And he was the richest man in the world. He's no longer the richest man in the world.
Yep.
Congrats, your country now claims
Bernard Arnault, CEO and founder of LVMH.
Is now once again the richest man in the world.
Luxury rules, baby.
Yeah. Well, it turns out that if you buy a company for no good reason and you lambast everyone on Twitter and you defriend everyone and you annoy basically everyone on the planet.
Yeah.
Turns out that your stock doesn't do so well and you don't actually.
Listen, I think, as much as he is a genius, he's not. He's a human being, and he showed us last few weeks that he's flawless. And
flawed.
Flawed.
Not flawless.
Sorry.
I think he might think he's flawed.
Sorry.
Yeah.
The word is flawed.
You're
right.
Definitely not flawed.
It's truly infuriating. I think the board of director is doing such a huge disservice to all of Tesla shareholders. This guy bought a company for $44 billion that he overpaid for, and now $500 billion has been lost in market cap from Tesla's shareholders because of his antics, and he's alienating some of his most fervent supporters.
Correct. Just the hubris that is ultimately been shown from this man. And I think Tesla will ultimately be fine, and Elon will be fine in the end. But power corrupts people, and this guy pretty much has as much as anybody at this point in the world. And it's just sad to watch.
Yeah, and not saying that he's not doing what he needs to do at Twitter and trying to remove some bias or whatever. I don't know what's going on at Twitter and wholeheartedly, but I know that it should not be on the outs like this, and he should
Yeah.
not be attacking people in that way.
That's-
And no CEO should be really doing this. So.
No human should be doing
Yeah.
this, let alone a CEO of
What's-
multiple companies.
So what is the board in all of this? Like I mean, that's for me that like this is a publicly traded company, one of the biggest companies in the world. Like I looked at the board, they're a bunch of nobodies,
Except Murdoch.
except James Murdoch, which by the way I just watched the HBO series, The Murdochs.
Yeah.
A really fascinating family. It's definitely Succession, the show.
Yeah. Oh, Succession was built after
James
them,
Murdoch
sure.
is not liked by his family. He's actually the liberal out of the Murdochs.
Which could mean anything. It could mean he's a moderate Republican.
Yeah, but it's really, I really
Yeah.
enjoyed watching it.
Yeah.
And I do think Rupert is one of the most evil human beings on earth, but that's my personal opinion.
The board has been MIA. It's just, I don't know if it's just a bunch of yes people on the board that have no control over Elon ultimately.
Yeah.
And his brother's on there, and
Yeah.
there's just been silence the entire time right now. So I don't know. So we won't beat this horse any longer, but just know
never
that,
a dull moment.
Yeah, just know that when you invest with Elon, there's always negativity surrounding the ultimately what's a very positive thing.
Yeah,
that he's doing in the company.
Yeah, 100%. So thank you all for listening to the show. It's been about a year that we have it going now. A lot of great feedback. Again, we knew when we started this that the world needed a new podcast, and we made it happen.
There's only like 3 other podcasts that exist.
No, but it's the feedback has been awesome. So it's December 16 today, whatever the date is, 15. Sorry. So what we want to do is kind of go over the year. I thought it'd be fun to kind of explore the topics that we've gone through this year and really seeing how did the year work out? Like, what did you get right? What did you get wrong? Right? I
think everybody got everything wrong this year. Isn't that no, I agree. Let's kind of talk about where we started the year. Yeah. And I think funnily enough, January, our topic for January was funny in and of itself. So Tim, you want to tell us what the title of the January podcast was?
Don't look at your accounts.
Yeah. There's no time I could reiterate that more than right now.
Wow. Full circle, baby.
Yeah, we come back to end the year in the same way. And ultimately, look, you can look at your accounts. Obviously, it doesn't do you any good, mentally speaking, to look at your accounts. And markets are cyclical. And it's interesting because I asked one of my clients that I talked to recently who was very nervous about markets.
Right.
And we made a ton of money for him in 19, 20, 21. And now he's kind of freaking out about it. And so I posed the question. I go, what if we didn't have this big spike in the market and then this downturn? Right. What if we just went up a little bit each year?
Right.
How would you feel? He's like, oh, I feel way better. I go, but ultimately you would be in the same spot that you're in right now.
Markets don't do that, though.
Markets don't do that. But but the point is to get people to think about their emotions, right? If they would have made 6% a year, consistently, they would have been fine.
Yeah.
But to make 10, 15, 20, and then negative 20 or whatever it is, like it feels much worse.
Well, I think what's interesting about this year, right? And we'll recap what's happened, but what's interesting is usually you buy bonds so you can help smooth out the returns, right? Right. And this year it just hasn't happened, right? So let's talk about what happened, what are the indexes are, and so forth. I know you're very good at benchmarking things and so forth.
I love statistics.
Yeah, you really do.
So we're NASDAQ this year is down over 30%. S&P is down about 20.
Yep.
The Dow is down, significantly less than the rest of them, around I think less than 10 now, because it's this year has been the biggest value to growth outperformance since 2001, I believe.
Yep.
And it makes sense.
Yep.
Yeah, that the last .com bubble, and we had a mini .com bubble, and the NASDAQ happened, I think, this year. So that's the major stock indices. The small caps down 20 some odd percent also. And normally speaking, in those times, bonds are there to say, "Oh, it'll be okay. Don't worry."
We call them a ballast, right?
Yeah,
the bonds
ballast.
are, right. They're there to kind of, if you fall, like bonds are there to kind of almost amortize your fall.
Yeah, they're the anchor. Except in this point, they're the anchor that dragged you down.
Totally.
So this year was the worst year that bonds has ever had in history.
Barclays Ag minus 13% this year.
Yeah, I think we're down now about 11. As the market looks towards more recession, I believe we end the year, pretty bad. But this is the worst year for bonds in history. It is the worst 3-year period in history. So
and flat for 5 years.
And flat for 5 years, and close to flat for 10. So it's been a really challenging market because our safe haven investments have been anything but. So there's nothing has really gone right in the investment world. Real estate's down 25 to 30%. So it's sort of kind of been a
when you say real estate down, like we haven't seen that just yet.
Yeah, sorry. So the difference between publicly traded real estate investment trusts, so the index that tracks real estate in the markets, is down over 25%. Whereas private real estate is down not nearly as much. Although if you look at your, one of those people who look at their houses on Zillow now, we're now seeing that we're back to where we were last year.
Listen, as anything else, because interest rates, who really impact everything, and I think this year, the lesson has been how much people appreciate the power of interest rate, right?
Yeah.
We had this, let's call it, 40-year cycle of interest rates going down since the late 80s. And now
we made it all back up in 1 year.
And then now, this inflation is really kind of creating some real issues with the economy because rates have gone up so much, so fast, right?
Yeah.
Like the pace at which rates have gone up is really what's kind of been interesting, right? Because we all knew interest rates going to go up. We all knew some of the assets would have to be repriced. We just did not understand how fast it's going to be because of the pandemic.
Yeah, and I think ultimately, the Fed is not letting the market play this through a little bit. We're seeing we're seeing inflationary data come down. And we just haven't had time. The market hasn't had time to process all this. So,
Jerome Powell said, the risk of a recession is less than the risk of inflation staying in the economy for a longer period of time. So in other words, he's willing to basically go into recession because he doesn't want inflation to stay and remain within the economy because that becomes sticky and it stays for the bigger problem.
It's true. It is true. And there is an argument to be made. So, everybody's banging on Powell, which I'm banging on him too. More so, I don't think you need to consistently have the overly hawkish tone. And just use the data dependent. Use the, you don't have to hike every single month. Right. And you don't need to say that we have to hike to 5%.
As much as I hate to say this, part of what the Fed does is looks as the wealth effect. Us making money, wealth effect is basically seeing our brokerage accounts, our investments go up in value. The Fed seeing that happen actually is not something they want to, because when that happens, that means that they can't really deal with inflation. So it's almost like they have to do this in order for them to kind of get inflation on.
And listen, they only have really one other time period as a playbook. And that was 40 years ago. And the only way to beat inflation was to raise rates to the point where the economy got hammered. And hopefully, it seems in all likelihood at this point that we're going into recession.
I mean, I think that's in the books. Right? I mean,
that's what the market's pricing. That's what everything is pricing. The bond market, we look at the stock market and we look at that as a barometer for recession and things like that. But ultimately, it's the bond market that's really telling the story.
The bond guys are the smart guys.
So for those of you to kind of clarify that a little more, the 1-year treasury is paying 4.5, 4.6, 4.7, depending on what day you're looking at. The 10-year is paying under 3.5 now. So what that is saying, that's a harbinger of an economic downturn. That's
what it just tell you is people don't want to invest for the long term. They'd rather put their money for the short term and see what happens in 6 months or a year.
So, and it does actually create a great opportunity for bonds because when interest rates fall, so we might have the opposite effect. Interest rates, long-term interest rates fall. That's actually good for bonds and for appreciation of bond prices. So we might be in a period where bonds actually, for the first time in my investing career, bonds have a legitimate rate of return
for sure.
And a balanced portfolio is a real balanced portfolio now. It's not like I'm going to earn all my return in stocks and maybe I'll earn 1 or 2%.
I've been doing this since 2006. And if one thing I've learned is everything is cyclical.
Yeah.
And what that means is things that don't do well this year will, and it's not an absolute statement, but
Yeah.
it usually
tend to
do better the next year or in subsequent periods of time. Bonds are that.
Yeah.
Tech stocks are that.
Yeah.
And
coming out of, it bears this point is like, if you're going into recession, right, value stocks tend to do better.
Yeah.
And when you're coming out of recession,
yeah,
growth stocks tend to do better. And I think, again, it bears repeating that the markets will bottom before the economy does, usually around 6 months.
Yep.
Right.
Yeah.
So hopefully,
yeah,
we're in that time already.
Yeah. Let's get out of the way.
Yeah.
Okay.
So
don't look at your accounts.
Don't look at your accounts.
And that was
everything will be okay, guys. Like, this is the thing. It might take a year, but we'll be back.
Yeah.
We had a great bull run before that. And we just got.
Listen, I think it's really easy to run from a burning home or whatever this thing is, because that's how he feels right now. But this is when the opportunities are.
Yeah.
You know what I mean? This is the, we try to also psychologically manage our own emotions and take advantage of times like this. Look at for real value, or look at for stuff that's oversold, because there's a lot of companies, great names, great sectors have been sold off for no reason.
I mean, not for no reason, but speaking of that, like, Tesla is a great example of this. If something could, somebody could just rein in Elon a little bit. Tesla is trading at the lowest valuation it's traded at.
100%.
So
it's not a cheap stock still, but
but forward PE with a stock that's growing 40 now. Obviously, there's recession coming, so maybe numbers get hit. But still, with those projections in place, it's still trading at the cheapest forward earnings that we've seen.
What a perfect segue, y'all.
Thanks,
Look at
man.
you. Because our Future Money 2 of this year was about EVs and battery tech.
EVs and battery tech. You guys heard of this company, Tesla? They have this CEO. His name is Elon Musk.
No.
So other than Tesla, right? Let's throw them, because everybody, we've beaten Tesla to death already, right? Like, but Tesla is by far the leader in a number of cars produced.
I am the most excited about this sector over the next 5 years, right? Because we haven't seen a sector that is grown so much, but yet still has so much more growth. I think if you look at like markets, right? Like China, for example, 25% of all cars sold. China is the biggest car market in the world. 25%. I think they do about 20 million a year. So about 5 million EVs get sold in China there. Okay.
Yeah.
The US is the second one, 16 million cars a year sold roughly. We have
we're not even at 10%.
8 or 9% penetration, going up from 4% last year, right?
Yeah.
So the market, the pie is just getting bigger, right?
For sure.
People are cool now buying EVs because they know that it's charging station. They kind of got used to the idea. It's no longer about the elites and the people that are rich, and like it's really something that is, and there is a lot of models. There's a lot of things to choose from.
So on my street alone,
there
are
Ayal lives in Santa Monica.
So this is the point, is that EVs are no longer for the elite. EVs are no longer just Tesla. Okay, on my street alone, there is Tesla, the Ford Mach-E,
nice,
the Hyundai Ioniq, is that what it's called, right?
Yeah,
the I-Pace Jaguar.
Wow, okay.
There's another one that I can't think of right now.
The ID4 from Volkswagen.
Yes, thank you. That's all literally in like a matter of like 8 houses away.
That's amazing.
Okay, so it's not all just Tesla.
Listen, when you think of California, I can talk about California for so long, but our gas prices are still $5 a gallon.
Yeah,
it's
true.
Like California figured out how to make gas more expensive when gas is going down.
That's listen, but we can't figure out the incentive for the $7,500 for the infrastructure bill.
Yeah,
have you tried to figure that thing out?
No.
Somebody asked me about it, and I literally went through, and it's like you have to have a PhD to figure out this thing. You have to find out if the minerals, 75% of the minerals came from North America. I'm just like,
I think 50%.
That's 50% of that. But the minerals have to come from, like, I have to source the material somehow.
Yeah, the car makers will figure that out. I think Tesla and Ford, they're probably fine,
I mean, I don't know. A lot of the materials come from abroad.
Yeah.
Right? So I don't know that, we think Tesla.
They did say that they think, but.
They think, but I mean, this thing is so convoluted. Like, just figure out a way to just say, hey,
we have to give a shout out to Biden for that bill, by the way. Listen, the Build Back Better bill, that was insane.
You mean the 72 trillion or whatever?
It was insane. The fact that they kind of brought it down to like 400 billion or so and really most of it was to battery tech and clean energy, sustainable energy. I think that's a really, really good investment for America over the long
For sure.
run. So,
and to source it is a great thing. You know, we want stuff being sourced here. You know, we're seeing a huge movement, you know, from outsourcing to sourcing in America now. So, you know, this trend, right? We're going to move to 50% in the next, you know, 5 years, 10 years, or 10 years, let's call it.
So again, I think that's what you're saying is keeping that long-term perspective is really key here.
For
right?
sure.
Because, you know, Tesla owns this sector, but there's a lot of other players, and also it's by the infrastructure, right? So that's why we like battery tech, we like mining, we like rare earth minerals, we like, you know,
and let's not forget
components,
chips that go in there,
right?
And so I look at this, right? The last proliferation we had like this was phones, right?
The iPhones, right?
When iPhone, right, Apple came out, and of course, you know, everyone's gonna say, well, they weren't the first, just like Tesla wasn't the first for EVs either, but they sort of mastered it. They created the brand. And then the proliferation after that, right? So we got Apple, Tesla was the Apple, and now we got everybody else coming in. But basically, over the next 10 years, there's going to be an enormous movement, just like there was in mobile devices, into the EV.
Rough numbers is about 1 billion cars on Earth, right now. About 100 million that get sold every year. So like that's kind of the replacement rate.
100 million.
Right.
So what goes in these things? Forget.
No, I think 75 million is a number. Sorry about that. But still, that. If you think about what's going to happen over the next 10 years, you know, like cities like Paris, for example, Paris as early as 2025, you can't really drive into the city unless you have an EV. Right. So
Germany's doing it. Germany, the home of the internal combustion engine, the cradle of that thing. They have those rules. China, US is a little bit slower, unfortunately, to getting there, but California is leading the charge on that. So again, the point is that when we make investments, right, a year like this year, a lot of times clouds our view of the long term and what we're trying to do. Right. Okay. This year you bought Exxon, you're crushing it. Right. But let's not forget that for 10 years that you didn't make money. Right. So over the next decade, and this is when we invest, we think about 5 years plus. Right. What is the trend? Where are the trends going? Is it going more towards oil? Probably not. Right.
I mean, no, absolutely not. Everyone is trying to get rid of fossil fuels. Actually, you know, one of the best books I read this year is called Electrify. And it's basically about how do we electrify everything from our transportation fleet to our grid and so forth. And it talks about how oil companies are going to be instrumental in that process because a lot of the oil companies are becoming green energy companies because they have to. Otherwise, it's going to be obsolete.
Correct.
You know?
Correct.
So I think that's really what's going to happen, and you have to watch for that.
Yeah, I mean, energy companies have historically had to adapt to what the new regime is, right? It used to be a lot of coal, and there used to be a lot of kerosene, right? Before oil came, I think kerosene was the thing. That Standard Oil, that Rockefeller, everyone knows him as the oil guy, right? But it was kerosene for lamps that originally is where it started. So they have to, and there's plenty of, you know, there's a lot of companies now that are sort of these new, like when we talk about next era energy, right? So it's kind of like a hybrid where it's moved a lot of its stuff into natural gas, solar,
wind. It's all wind and solar.
They have natural gas too, but they've moved out of those things as a transition. So this is a great space going forward over the next 5 years, I think.
Then we moved on to talk about Ukraine.
I wish we weren't still talking about this, unfortunately.
You know, the war kind of broke out in January, but really, what was it?
February is really where,
But really, kind of, everyone thought it was going to be a small conflict that would get resolved, but here we are, December, and thousands of dead, unfortunately, millions of refugees. You know, Putin is still alive somehow. The Russians are running out of ammunition at this point.
But thank God for the Chinese, right, who are now willing to buy all the Russian oil.
Yeah, it's unfortunate.
So, you know, China and Russia are forming the axis of evil again here.
Well, I think the thing is about China is they obviously have to look after their interests, but ultimately they can't really get out of the overall international kind of order, right? Because they just provide a lot of the supply chain, and it's part of their prosperity.
That's very nice of you. I think China just doesn't give a damn. If they have an ability to get oil cheaper from the Russians, they just don't care.
Yeah.
Frankly, they don't care about human costs because they create, unfortunately, a very high human cost.
Okay, well, we're talking about Ukraine here, so
no, it's sad for the people of Ukraine, I think.
Yeah, and it's really created like a really, really awful situation for Ukraine, obviously, for Europe, also for Russians who are not aligned with the regime, because their economy has also got decimated.
Oh yeah,
sanctions, right?
Which is most people are not aligned with what.
For sure, but there's nothing they can do.
There's nothing they can do. Yeah, and not to mention the shit they're getting for it.
Yeah,
for just being the word Russian, and they're like, I'm not invading Ukraine.
Yeah.
And it's really sad.
A lot of them laugh too.
Yeah. The human toll, the cost of energy, the crisis in Europe for energy now. It's just really sad, and we only hope because Russia has not accomplished anything except killing a lot of people on both sides.
And that also exasperated this whole crisis that's happened. And part of why the market also has been really tough this year is really because this cost of energy has gone up for everyone. The cost of food has gone up for everyone. Ukraine is a big producer of grain and other things. So any conflicts like this, especially in Europe, which we haven't seen anything since World War II, like with this severity is really disruptive to everything. So
for sure.
Adding basically more fuel to the fire, basically. That's
literally.
Right? Literally.
It's like literally. So hopefully this gets resolved soon. The only way out of this is Putin has to have some kind of moral victory for himself.
Or they have to figure out some kind of, seize, some kind of
but like you're Putin and you're going in guns blazing and you're like, oh, we're just going to decimate this place. And all you've done is decimate yourself. He's a despot leader. He's not going to be okay just leaving and licking his wounds.
I think if everyone has learned anything from history, right, you can't beat someone in their own home. You just can't.
Well, I mean, definitely now that the winter's starting.
Exactly.
Plenty of we talked about plenty of failed attempts at war during the winter in Eastern Europe.
Totally. So that Ukraine happened. Then we talked about crypto in April of this year, right? Wow, we're really called it.
This is really good.
Because that was the start of like the real bubble.
This is the crypto. That's when we really started entering the crypto winter.
The frigid winter.
This all made worse obviously by what's happened recently with FTX and SBF.
So let's give ourselves a little pat on the back. When we decided to be able to manage digital assets for clients, we talked to FTX as one of the custodians potentially. And I'll give this to Zach, who's kind of been doing this for us. And FTX was one of the firms that we didn't want to go with because of how convoluted they were, and we didn't really understand what they were doing. But the reality what's happened here is this guy came in and tried to be the prince with the shining armor, trying to save everyone. He ended up just basically a fraud.
Just a complete fraud. Hopefully he's going to jail.
He's looking at almost 100 years of jail.
I mean, how can you argue that this is not just an outright fraud? This is digital. This is made off 3.0, I guess, because it's Web 3 we're on.
This is again happened in the financial crisis with Madoff. It's nothing different, right? Someone who was just taking clients' money and really using it for things that they're not supposed to, right? And we had a lot of clients ask us about staking coins and all these other coins. And granted, when people come to us, we tell them if you're going to invest in crypto, it should be a very small percent of your money. Speculation.
You should be okay with it going to zero. Because there's a difference between the speculation. I think it merits us talking about it. The difference between an investment and speculation is with an investment where the market goes up and down, there's cash flow, there's intrinsic value in equities or in real estate. Bitcoin, Ethereum, Shiba Inu, it's worth whatever somebody's willing to pay for it.
Sure, that's exactly it.
So
and frankly, there is no real utility just yet, right?
Bitcoin has some. The idea is that Bitcoin and Ethereum are the ones that at least have some kind of utility.
But so think of
Remains
it as
to be seen, though.
Think of it as you are 1999 and there is this thing called the internet. You don't even know what it's going to be, but maybe.
Well, it was like 1993, really.
Yeah, 1993, right?
Yeah.
So that's exactly how you want to think of it,
Yeah.
And so it's mayhem. I think everyone is basically either staying the course because there's nothing they can do.
Yeah.
They've lost so
They've
much
already
money,
down 75%,
right? Or are just completely done with the asset class.
Yeah,
which I get.
But if crypto is here to stay, what happened here, this terrible thing that happened, is going to bring about ultimately what is necessary for this field, which is regulation.
Yeah.
Okay. Throughout history, it doesn't matter what period of time you're in, doesn't matter what asset you were in, people will take advantage if there's not regulation.
Turns out there's a bunch of crooks in crypto.
Dude, we talk about this all the time, right? Like the whole idea of crypto and decentralization and this libertarian idea. Yeah. Another name for decentralization is anarchy.
Yeah.
Right? Like yeah. I would love if I could just leave my door open all day, every day, and be friends with everyone, and no one would take my stuff.
Yeah.
But the reality is that's not the way the world works. Is people will always find, not all people obviously, but some people will find a way to take advantage of the scenario.
Yeah.
And we need regulation. And everyone hates the R word, regulation, but we need it.
Yeah. Listen, we are licensed advisors.
Yeah.
We go through a lot of diligence, a lot of things to be able to do what we do. And we take our jobs and our responsibility very, very seriously, And when we see some of the shit that the crypto people do out there, and you wonder, like, how is it even responsible to have some of these people there? So I think, as you said, it's a good thing. One of the best part about our country and our industry here is we have rules and the SEC and really some safeguards for people. It's not perfect. Yeah. But your money is safe, right?
Yeah.
You have FDIC, SIPC, you have all these things that are there to safeguard you. You have licenses that people have to do before they can give you advice and so forth. So with that being said, I think you there is a lesson here, and the lesson is there is crooks everywhere, and you have to do your research. You have to be smart.
Yeah, absolutely.
And then May was kind of the lows of the year.
Lows, yeah.
So we started really. That's when the banging on the recession where it started, right?
Yeah.
Right. That's when rates. I think that was the second or the third 75 basis points raise.
Yeah. And then here we are. We're kind of in the same place. As long as the Fed remains in this hawkish tone, the market has no chance to go back up, fully.
No,
because the Fed has to back off. Yesterday, the market's down today because yesterday the Fed said we're going to probably raise next year also.
Yeah.
I don't know why that's necessary, but whatever.
Again, I think the Fed just want us to feel rich.
Yeah, to create this self-fulfilling prophecy. But again, do we need rates at 6%?
Yeah,
I don't know.
Yeah, and again, I think what we talked about in May about recessions is still very much true. Yeah. And if anything, actually, it's more real now. I think the recession risk has gone from maybe 25% to like 60% now.
If probably not more than that. Yeah,
exactly.
I think pretty much everybody's in the same camp right now, is that we're going there because the Fed wants us to go there.
Yeah,
frankly.
100%.
But the hope is that it's a shallow one. And again, that market's bottom before that.
Yeah. And by the way, I think it's important to say that recessions are not all too bad. And the reason I say this is because a lot of froth gets built to the economy, right? Markets and economy needs to be lean, right? Yeah. Recession kind of takes some of that fat out of the system, and and it creates kind of a new environment for new companies, new businesses to really thrive. That are a lot more sustainable, or a lot more kind of productive in the way that they're built.
Yeah, so, I mean, what better way to think about it than real estate, right? Like people can't afford to buy a house.
You're getting ahead of yourself, bro.
I'm sorry. I apologize. Recession. All right, let's move on. What's the next one?
We talked about streaming in June because Netflix missed their numbers.
Yeah.
And it really kind of, I think the stock got almost halved in the space of a month or so.
Yeah, so Netflix had 2 separate times this year where the stock was down over 25% in a day.
Yeah, exactly.
Which is crazy.
Yeah. If you bought that stock that day.
Yeah, if you bought the stock, after, you're before today, you were up somewhere like 80 or 90% from the low.
Yep.
So, again, this is where we talk about opportunities being created. Netflix, there was an overreaction to the idea that they might have a loss of 2 million subscribers that they said at the time. The market gets overzealous right now because everything is so negative.
Yeah.
Everything gets hammered.
But I think it's a little bit more than that, right? Like Netflix was such a big benefactor from the pandemic.
Sure, 100%.
They doubled their subscriber base basically in 2 years, right?
Correct.
And then the valuations got out of control, and then you got this,
and now the valuation came right back in line with what it should, with a good valuation, and then it was a good buying opportunity. So valuations matter. We talk about the future of investments, and when you invest in tech stocks, there's always going to be more volatility.
Yep.
You can't have higher reward without higher risk. It's just the way it works. And if you're going to invest in a company that has a longer time horizon, you just gotta be willing to accept more downside, but you also have to be willing to add to these positions when things change, when things get bad, and that's always a good strategy. Now, is it 3 months? Is it 6 months? Is it a year?
Yeah,
we don't know, but that's why you dollar cost average into some of these positions during that time.
Yeah, and also this is why you invest in good leadership, right?
Yeah.
Netflix has been a leader in the streaming space and continues to have some of the best people in Hollywood. I don't know if you've seen anything about a show they released this week from the Addams Family. It's called Wednesday. Yeah, they did 750 million streaming hours.
I watched a little bit of it.
Is it good?
Yeah, it's not really. It's kind of more like a teeny, younger adult thing.
Yeah,
it was like fun.
Yeah,
it wasn't groundbreaking.
Yeah,
but
I'm saying this because Netflix is just a hit machine. They keep doing this over and over and over, like from the Dahmer Show to Stranger Things to they've done so. 2022 was one of their most successful years, and people underestimate how hard that is to do.
For sure. I mean, they have like 1 billion shows, to be fair.
Yeah, to be fair.
And to sort of talk about the other side of the spectrum, which is the company that has amazing content, doesn't release 1 billion things, but has had a very tough year. Well, actually, I was going with Disney. Apple's confusing to me a little bit. Like I've heard, they have a couple of really good things.
Come on, dude, they won Best Movie last year with Coda.
But is anyone really honestly, Best Picture doesn't mean anything to me. Generally,
it's a great movie.
Generally, what it means is it's I watched it and I love it because I have a deaf niece.
Yeah.
So to me, it was amazing.
Fantastic movie.
Yeah. But Apple is sort of like they have all these random things. With the exception of Ted Lasso.
Come on, Ted Lasso is the best thing ever.
I love Ted Lasso.
Right before the World Cup.
Ted Lasso is one of my favorite shows. But that's really all. But I was, talking about Disney.
Yeah.
I mean, Bob Iger, who was Disney CEO for a very long time, probably one of the most successor CEOs
in Hollywood, really.
In Hollywood, leaves.
Yeah.
His predecessor has all kinds, or his not predecessor, but successor has all kinds of issues. And Bob Iger comes back because while Disney streaming is growing, it's losing more and more money. So basically, they're spending a ton of money to gain subscribers, but they're losing money on this venture.
It's true. I mean, they've basically, Bob Iger kind of started the Disney Plus, which really saved the company because the world has moved it towards streaming.
Yeah.
But then Bob Chapek, who came on after him, just was not able to manage it properly and pissed off a lot of creatives.
Yeah, because he's a parks guy.
Yeah.
Like, what is he? He's trying to manage creativity.
Yeah.
And frankly, since Iger left, the movie studio business has been terrible.
Yeah.
Like Disney was the king when it came to
with obviously the pandemic and the movie,
and granted, part of that was the end of the Avengers saga. Was kind of the peak.
But they still have so much IP.
They have a ton of IP and the Marvel stuff. By the way, the stuff, and me, I'm a huge Marvel fan.
Yeah,
the stuff that they have on streaming is actually significantly better than the theatrical releases that
Really?
they had.
That's
Yeah,
amazing.
like their content on streaming, whether it's The Mandalorian or Andor with the Star Wars series,
they've done a lot.
So good. WandaVision and Loki and all the, like these these shows are so good.
That's true.
But Disney's losing money, and then meanwhile the theatrical releases have kind of all been a bomb, and now Avatar's coming to the fray tomorrow, and frankly I think it's gonna be a disappointment
coming
too.
out tomorrow.
Yeah.
Oh wow.
Right. You didn't even know. You didn't even know.
That's gonna do well.
The highest grossing movie of all time until Endgame.
Yeah.
And you didn't even know the sequel was coming out tomorrow.
No, I knew it was coming out. I didn't know it was tomorrow. That's
so. But again, you know, these companies like Disney has great IP and forever IP. That's what I love about Disney.
Yeah. So yeah, great theme. We love the theme, but obviously a lot of disruption there. Yeah. There's going to be some new winners and so forth. Then we had a friend of GK, a friend of mine, John Grauman from the agency, who's one of the top real estate agents in LA and the country, really. Yeah. And it was really awesome conversation that we had about real estate, really. And it's actually John had a show on Netflix called Selling Sunset that just started 3 weeks ago. #1 show.
Really?
Across the globe.
Oh, is it across the globe?
The globe. For 1 week.
Man, we need a Netflix show, man.
It was amazing. You know, I mean, I saw
you can't really do a show about buying stocks. It's a little different.
Yeah. I think it has something to do with the fact that people love LA and love
for sure.
You know what I mean? That is kind of that mystique, you know.
Yeah, for sure.
And glory. And you know, he was really worried because his reality show about how he's going to come out, but ultimately he came out as a professional, which is what he is. So, so that's a plug. Check it out.
So real estate, going back to what we're
the conversation was about like, where are we? You know what I mean? What's happening? And I think John said it best. Said, listen, buyers right now think that it's a 2008 situation, so they're going to get a deal of a lifetime, and sellers really
are still pricing their house on 2021 terms.
So then is like disconnect between buyers and sellers, and what's real is prices have gone up. So the interest rate, which is ultimately prices the cost of ownership, cost of owning a home, which is your mortgage, has gone up tremendously. 50, 70,
almost 50% now.
Yeah.
It's interesting that as rates keep rising in the market, so the treasury, the 10-year, the long bond, the 10 and the 30 really kind of dictate mortgages more.
Yeah.
So even though rates keep going up, actually we're seeing a little bit of a fall in mortgage rates because the longer term bonds are falling because of fear of recession.
And also I think what's happening is real estate is not just about rates. It's also about supply. People have to live in places regardless, right?
But it's also about the economy, right? So it takes a lot longer for this to trickle through the system. If we go into recession, people have to lose their job, people have to move out, people have it takes months and years for this to really churn through the system.
Yeah.
Where, so real estate is kind of, where we were in February.
Right.
Like they're just there now.
Yeah. And I think I just met with the agency last week, and I think they're seeing the same kind of timing where people are just not sure where things are going. So people don't want to commit either way. So I think you're going to start seeing that next 3 to 6 months.
Yeah.
But ultimately you need to be able to make some decisions and make some moves. And I think that's going to happen over the next 3 to 6 months. So
maybe a year, but so we had real estate.
Yeah. And then we had an awesome conversation in our founder series. Founder series is basically where we interview founders and really kind of talk about their amazing stories with Ward Poulos, one of the founders or co-founders of ZipRecruiter. And that was an amazing conversation.
Loved it, and I love Ward in general. He's such now a good friend of mine.
Yeah.
And the way they started ZipRecruiter and about how you got to pivot, right? They, they started in not a great economic time. And you got to adapt to the scenario. And ultimately it's about who's running your business, what team is behind that. And that's going back to the Elon thing. That's what frustrates us about him so much is that as a thinker, he's one of the leading people in this world. And sometimes that gets lost because of his antics. But like, if you have a strong team behind you, that series with Ward is a great message to people in the tech world today who are fearing, what's happening in the economy.
Yep.
Like, just stay resilient, there will be another day to fight.
Yeah.
So just don't worry.
And I think really Ward kind of drove home the point that in times like these, recessions and tough times, right? What are you made of? You know what I mean? Is your product, good enough? Can you be more efficient? Can you run your business in a way that can sustain? Can you get your burn rate down? Can you really kind of figure out really how to survive in this environment? And this is really what's beautiful about times like this is people that can make it will definitely emerge as
pressure
leaders,
makes diamonds, as they say.
There you go. So that was awesome. I was excited about that. And then in September we talked about recession again. What the heck is a theme here, man?
Yeah, we started talking about recession here too. I think it's on everybody's mind, and we don't have to keep revisiting it, but it's top of mind for everyone. But I think the important part is that we will get through it, guys. Recessions don't last nearly as long as expansions do historically. So there is we're gonna end this. What was the next topic? Because we want to end this with
Kyle.
Kyle at Tailspin and the crazy stuff that's been going on with VR and AR. We got to wear our glasses and the headsets.
Yeah, I know. We talk about the metaverse a little bit and what's happening in that space, and the next basically frontier in computers and really extended reality, so AR and augmented reality and VR and kind of where things are going and what's happening in that space, which is I think is going to be an exciting environment to be part of, is still very nascent.
It's nascent. You use the word frontier, which I think is a great use of the word, because if you know what a frontier is, it means basically an unoccupied piece of territory. So a lot of people go to the frontier, and a lot of people don't make it to the frontier. Right. But it's a new stage. It's the Wild West out there.
Listen, this is called future money, right? The idea here is for us to figure out where things are going, right? Investing is about figuring out where the puck is going, where what's the innovation. When the iPhone came out, nobody knew where that's going to go, but that created, Google Maps, which created Uber and Netflix, and all these things kind of start somewhere, and then more things get built on top of them, right? So I think it's really important to start looking at that stuff and really not be enamored by what's happening today and just freak out and just kind of think about it. And I think that's our job really as a thematic investment firm. We apply everything from the proven rules, which is asset allocation, diversification, and so forth. But also, put some, some spice on the dish, if you want to call it that, which is, invest in things that are exciting. The Nvidias of the world, the Tesla when they were exciting,
when they were not bogged down by other stuff.
I think that's really what we
and then to cap that off, I think to leave the end of this year, which has obviously been a very tough one investing wise, with an expression of hope, right? We're not in the worst case scenario that we've ever been in. We are in the most negative bearish sentiment since 2008-9, and if you remember back then, things were way worse, in my opinion, than they are today.
I mean, I was managing money in 2008, 2009, as you were. The financial system was going to collapse.
That's what it felt like. I mean, it literally was. It was like a back channel saving of the banks.
People were waiting online to take their money out of the banks.
And that's not where we're at. Our biggest problem right now is that demand is still a little bit too high for the supply. We have there's no question that there's issues. And investing, you're always going to feel like there's something scary on the horizon.
Right.
It's always going to be that way.
Right.
But we get through it, and the market marches higher. There's my son, I have him read this investing book, and he asked me about buying low and selling high.
Right.
And I said, that's true. However, what does high mean? Because the market consistently goes higher.
Right.
So when is the high point to sell? Well, that generally means that you might want to de-risk, or you might want to, you see some things. But we're not really selling high, because markets will march higher over time.
Sure.
Right. So if you're
time is your friend.
Time is your friend, especially if you're younger. Like, look at this as an opportunity, because historically speaking, this will change at some point. And there's going to be, great investments to be made, future technologies, areas of the market that today, when we look back 5 years from now, we're going to go, oh my God, I can't believe I didn't do more of that. Right. And that's what we always say. We go, I can't wait until I get that opportunity to like pile into these things. And when the time comes, people go, oh yeah, no, not for me.
And again, as I said earlier, like, everyone wants to run out of a burning building because it feels that way.
Yeah.
But ultimately, from an investment standpoint, these are the best times.
You're not gonna die from running into this building. You know, the burning building here.
Analogy doesn't work.
It's more like maybe the building's a little hot right
it's
now.
A little warm.
Yeah.
It's a little warm.
No, but I get exactly what you're saying. It's easy to say it when your accounts are up.
Yeah.
But when your accounts are down, you're feeling emotional. Everything sounds scary. Russia, inflation, recession, all these words. Right, and the media likes to bombard you with these words because that's what creates clicks and views.
Yeah, things are good doesn't really sell.
Right. Jobs were still good, and the economy is still good. Now we're probably going to a downturn, but it's not the first, and it won't be the last time we're having this discussion. So keep your eye on the ball, keep your eye on the long term.
Yeah,
stay with us. We have plenty more to talk about next year about some ideas that we have about future money and future technologies. Where we actually, hopefully, 23 will be the time we make money.
I know you are. I'm too excited about what's ahead. I really am.
Yeah,
there is a lot of cool stuff. We've already been talking about some of the themes that we're going to be discussing next year.
Yeah.
But yeah, have a awesome for connecting with us. Got a lot of amazing feedback, notes, comments. Please keep them coming.
Yeah.
Thank you for supporting us. Thank you for listening in. Thank you for trusting GK with managing your money, really. And have a beautiful holiday. And
happy holidays, everyone.
2023.
Sounds good.
Cheers.
Bye.